Let's start off with your call on financials. As we get bank earnings this week, we'll know a little bit more, but are you looking for signs of balance sheet distress or funding challenges at all?
I think there's a big trade-off in banks. On the one hand, interest rates are going up, which makes it easier for banks to make money out of their day job. But at the same time, of course, as interest rates go up, people worry about the economy and what the impact that could be on credit risk and so on. And we think the good news on interest rate margins and profits will be enough to counter the fears about balance sheets and credit write-offs.
And there is the illiquidity concern when it comes to treasuries. Is that a sign of dysfunction to you yet? Are there signs of financial stability worries? And because potentially that will be the only thing that causes the Fed to change course.
Yeah, I mean, the US market, the US Treasury market has been wobbling. The UK gilt market has definitely wobbled, right? So, yeah, there are issues at the moment because interest rates are just going up so fast. We were expecting interest rates to go up, but not this quickly, and that's creating disruption, mark-to-market problems in all of the bond markets all around the world.
We've been seeing, Rob, tech really pressured given that yields were rising, but you're still overweight on the sector. Why?
Yeah, we did a lot of work earlier this year looking at the sensitivity of tech, the NASDAQ and so on to rising interest rates. And everyone knows that when the S&P was down 2% on higher rates, the NASDAQ was down 4%. But I think the game is moving on a little bit from there. And people are buying tech in a relative sense at least because there's better earnings defensiveness in parts of the big blue chip tech sector relative to what we think will be earnings weakness elsewhere in more cyclical stocks.
You mentioned the UK gilt space and, of course, a massive volatility there. How do you look at UK assets right now? I mean, I must think that given the enormous sell-off that we've seen in that market, that stocks could be cheaper at this point, but can you actually bargain hunt in an environment when you don't know where the politics are going as well?
I would sort of distinguish between bond assets and equity assets in the UK. We're actually overweight UK equities, which is quite a controversial call at the moment. But I would emphasise to your viewers that 70% of FTSE 100 earnings come from outside the UK. So really the FTSE 100 is a global earnings index, not a UK earnings index. So that's one of the reasons we actually like the UK at the moment from an equity perspective. From a bond market perspective, of course, it's a completely different story.
Do you see opportunities given that with the kind of macro and rate-driven disruption to markets, it's a fairly indiscriminate sell-off, right? So for Europe, for example, do you see opportunities there that are not being taken up at the moment?
We kind of like the UK more than continental Europe. I think continental Europe is closer to where the problems are, particularly Ukraine, gas prices and all of these sorts of things. So within Europe, I would emphasise I like the UK over continental Europe. I mean, there are issues, major issues, that we've got a tough winter to get through in continental Europe, right? So we're not that keen on that part of the continent, and we would prefer the UK right now.
The other question, of course, going into earnings season is whether valuations are low enough to meet expectations. Do you think that they are? And is the major driver for this market continuing going to be central banks, or are we looking more at the other macro elements like economic activity and the recession risk?
Yeah, I've got a way of describing it to clients, which is that we think the market's probably on the right PE now. So let's say we started this year with global equities trading on 18, 19 times. They've derated all the way down to 13, 14 times. So I think we've got the right multiple, but I think the problem is we probably haven't got the right E. So we've got the right PE, not the right E. So we're going to move into a stage now where the market is driven more by fundamentals and earnings and less by interest rates.
A huge piece of the uncertainty is China. Are you expecting a pathway out of COVID-0 after the Party Congress? What does that mean for Chinese equities, which have been so beaten down? Yeah. But obviously the longer-term growth story could still yield positivity, right?
Yeah, I'm a bit of a stale bull on China. We moved China to overweight 2-3 months ago. It hasn't really worked. And part of the logic behind that was that we could see some potential catalysts coming out of China opening up, or maybe some fiscal policy around the Congress, or maybe some rate cuts. And it is the one economy in the world next year where we've got an acceleration in GDP. So I can see a bunch of factors that could move and catalysts that could move in China's favour, which is why we're overweight. And I'm sticking to that one, although it hasn't really worked up to now.
We'll chat to you after the Party Congress and see whether that changes.
Yeah, absolutely.